The 11th edition of the Dubai Precious Metals Conference concluded today, with many experts in the sector taking part. Gold's leading indicators currently remain bullish, with forecasts saying the yellow metal will cross the $2,200 mark next year. Andrew Naylor is head of Middle East and Public Policy at the World Gold Council. He joins us here in the studio this evening. Great to have you with us, Andrew. Thank you very much for being here.
Thank you. Good evening.
How do the supply and demand dynamics, set the price for gold?
Well, it's a very interesting question because it's the uniqueness of gold demand in particular that means that gold performs very, very differently to other asset classes. So, first of all, supply. 75% about is freshly mined supply. 25% is recycling, so that's people who've bought jewellery, who've bought bars, scrap metal from industrial applications being recycled. And demand usually, or historically, has always outstripped mined supply, and it's recycling that takes on some of that extra demand. When it comes to demand, though, there are four sectors of demand. You've got jewellery demand, you've got bar and coin investment demand, you've got central bank demand, so about 18% of annual demand is from the official sector, from central banks, and then you have about 7% of demand on average comes from the technology industry. And each of these drivers of demand behaves very, very differently. So some is pro-cyclical, some is counter-cyclical, and what that basically means is that gold performs very, very differently to other asset classes because of the diverse nature of its demand.
Is it still as popular as an investment at the moment, with so much out there, so much choice?
Well, there's a lot of choice out there, that's for sure, but if you look at recent statistics, investment demand globally is up, and here actually in the UAE, we released our recent demand statistics just a few weeks ago, and investment demand for gold in the UAE was up 57% year on year. So from an individual point of view, lots of interest in gold as an investment asset. Going back to the central bank story, and actually over the last 18 months, 2 years, it's really been a central bank story. Central banks are record buyers of gold in recent times. They've been net buyers since 2010. Central bank demand for gold, which is essentially investment demand for gold, that is very, very robust indeed.
As interest rates rise, how does that affect the price of gold? And then, of course, when interest rates then come down again?
Well, that's right. Gold isn't highly correlated to many other asset classes, but the one indicator that a lot of analysts look at is interest rates, in particular US interest rates. When US interest rates are up, the opportunity cost of holding gold tends to go up. So that's why in a high interest rate environment you tend to see a softening of investment demand for gold. And we've seen that recently. We're in that high interest rate environment, and investment demand from institutional investors has been fairly flat, I would say. But as that starts to be priced in, we'd expect when interest rates start coming down, we'd expect institutional investment demand in particular to start picking up again.
And I mentioned in the introduction that gold might cross the $2,200 mark. Do you think that's likely next year?
Well, we don't forecast the price specifically, but I would say the fundamentals look pretty robust. We're expecting interest rates next year to start to come down. That will probably or could spur institutional investment demand for gold. Economies, as they start to pick up again, you'll see consumer demand picking up. So the big markets of China, of India, which dominate consumer demand, they're looking fairly robust as well. So I think the fundamentals are certainly there for a positive performance for gold.
Great. We'll leave it there. But Andrew Naylor, really appreciate you joining us. Thank you very much.
Thank you.